From its top in 2011 to its bottom in late 2015, the gold price has taken many investors on a roller coaster ride. One mining legend has exploited this 6-year bear market to make the most aggressive moves of his career. The company he founded, along with 2 others which he backs, are the full package. Shareholders in his billion-dollar company call him the Millionaire Maker and are positioning in his latest deal. It's your turn to understand what he is all about. Dig deep and research now at portfoliowealthglobal.com/goldultimate and portfoliowealthglobal.com/gold2017. The GDXJ Rebalancing has created this opportunity. It's up to you to seize it now. Welcome to the CEO's Open Discussions Corner at PortfolioWealthGlobal.com. My name is Michelle Holliday. I'm thrilled to welcome back to our show Mr. Rick Rule, one of the premier analysts, financiers, and investors in the natural resources and commodities sector over the past 4 decades. Rick is founder and chairman of Sprott U.S. Holdings, Inc., one of the most recognizable, respected authorities in the mining industry in the world today. Rick, thanks for coming back to the show.
Thanks for the opportunity, Michelle. I appreciate it.
Now, Rick, I know that you have been around the industry through many cycles since the 1970s and that you study patterns in order to avoid mistakes based upon historical performance of assets. What, in your opinion, are the telling signals that occur just before the beginning of a junior resource bull market? And are there indicators that will predict the longevity of a bull market?
That's a great question, Michelle. One of the slogans that we use at Sprott is that in capital-intensive cyclical businesses like natural resources, you are either a contrarian or you will be a victim. The condition in the market that sets the stage for a bull market is an ugly, ugly bear market, a situation where people aren't merely bored with natural resource stocks, they hate them with a deep passion. Conversely, the resulting bull market becomes the author of a bear market. You can see an impending bear market taking place when investors are rewarded even for their mistakes and share prices go higher. The reason for this is fairly self-evident. The human condition is that our expectation of the future is set by our experience in the immediate past. And a punishing bear market makes us and all of our competitors very cautious and leery about investing. A rip-roaring bull market makes us all very aggressive and confident. And so the truth is that you absolutely can measure either the market's response or your own psyche. If you are beginning to think you understand the business and you're making lots of money, it's time to begin to beware. If you're absolutely disgusted with the sector and you wish you never learned to spell gold, it's the time to begin buying aggressively.
Wow, that's so interesting. Right now, looking at the industry as a whole, what is the least expensive business model to fund and raise money for? Is it exploration, development, a producer, a royalty company, or an optionality play?
Right now, the money that has been made by people in the royalty and streaming business is such that probably the cost of capital for royalty or streaming businesses is lower. Whether or not that's advisable, in other words, whether taking the money is advisable, is an interesting question because you are competing with companies that also have a very low cost of capital and they've been in business for a very, very long time. The truth is that we're in an interesting market generally in terms of raising money, and I think a fairly intelligent market in the sense that many of the untried personalities are having trouble raising money, but people who have been serially successful over the last couple of business cycles are having no trouble whatsoever. What seems to be working in the market right now is personal brand associated with the management team.
Now, Rick, Why does gold cost over $650 to dig out of the ground, but silver is less than $20? Is it because of rarity? And if so, then the current production ratio of the 9-to-1 would indicate that either gold companies could drastically cut their costs to about $180, or are silver companies pulling off a miracle?
I think most of the answer comes from the fact that probably 70% of the new mine supply of silver comes because silver is a byproduct of other metals. In other words, it doesn't come out of silver mines per se. The silver is produced as an adjunct to producing lead, zinc, copper, or gold, so that you have other commodities that pay, and you get a byproduct credit in the silver. The silver is an ancillary revenue stream from primary production of something like copper, where most of the costs of production are associated. Gold, by contrast, generally comes out of primary production, that is, gold mines. And it's worth noting, Michelle, that the number that you quote, the sort of $700 an ounce number, is the cash cost number. The all-in sustaining cost number, that is, when you add back all of the other costs associated with production, is in fact substantially higher.
Oh, wow. What would you say it is?
I don't know for the industry as a whole, but my suspicion is it's above $1,000 an ounce. That is, if you add back exploration activities, off-site general and administrative expenditures, and in particular, if you add back prior year write-downs where companies wrote off unsuccessful or overpriced efforts. They never report that number in all-in sustaining capital because they've written it off their balance sheet. But the truth is, it is a cost. It's money that went, if you will, to money heaven. And a rational analyst would pay attention to it.
Money heaven. It's just gone.
That's right.
Now, why are there so few discoveries these days? For zinc, it's been almost 2 decades without a new major deposit. Gold, many years. Silver, the same. Is this something that we can continue to expect?
Yes, Michelle. The exploration business is a very long-term business. In my experience, once an exploration model is employed in a certain district, it usually takes about 10 years to begin to generate substantial discoveries. The great gold fields of northern Nevada, as an example, were prophesied, if you will, in the 1960s. In a wonderful article called The Alignment of Mineral Deposits in Northeast Nevada. The first discovery, the Carlin discovery, was, if my memory serves me correct, we discovered in 1974, and it really wasn't until the middle part of the decade of the 80s that the terrain and the exploration technology were well enough understood to yield discoveries. And it's similar with major mineral deposits around the world. It takes a very long time. And the truth is that we have been underinvesting in exploration for a very long time. So it makes some sense that these lag times would be extended. The other problem that we're facing as an industry is regulatory and political opposition to exploration in developed nations, places like the United States and Canada, that have the infrastructure that is necessary to put large projects in production, at the same time that we have political and social turmoil in underexplored countries, places like Russia or the Congo, that might be more geologically prospective. So the dearth of discoveries that we're facing now is, one, a consequence of the natural progression of exploration, 2, underinvestment over a very long period of time in exploration activities, and 3, political challenges, both in developed countries and in frontier markets.
Wow. Now let's talk about specific business models, Rick. If you were raising money for a new company in today's conditions and you were the guiding force behind it, what commodity and what business model would you pursue?
I'm agnostic as to commodities. Right at this very instant, I might be interested in gold and silver because I think gold and silver have the most dramatic near-term upside. But the truth is, in my career, many commodities have treated me well. So I'm really sort of commodity agnostic. As to business model, because I have a reputation in the exploration business, I would probably choose to focus on exploration, where as a consequence of my experience and my reputation, I would have a competitive advantage. And drilling down a little deeper, the prospect generation model, which is a model in which you hire a technical team that has a recognized specialty, either by terrain or deposit type, and you employ that intellectual capital in exploration, but you allow other companies the opportunity to fund your exploration in return for a share of the discovery. That model is the model that has really been responsible for my outperforming my competitors as an investor in exploration over 4 decades. It's a model that requires patience and discipline, but it's a model that has generated investment returns that are about 3 standard deviations better than the expected returns over the last 40 years.
Now, did you create that model for yourself? Because that's very interesting. Or did you learn that? Did you have a mentor?
I'm credited with creating the phrase in the mining business, but the truth is that I myself parachuted into mining from the oil and gas business. And the prospect generator business methodology in oil and gas exploration is 100 years old. I myself worked for a private prospect generator in the oil and gas business in the early part of the 70s before I came into the mining business. So for me, it was established. In the mining business, it was unusual.
Now, regarding uranium, the U.S. is importing about 95% of the entire supply, although close to a fifth of the population is dependent on it. Are there no viable U.S.-based companies?
There's no viable company anywhere in the world at this commodity price.
Wow.
The International Energy Agency, who we would hope knows, believes that the total cost of producing a new pound of uranium worldwide is $60 a pound, and yet the stuff sells for $22 a pound. That means that the industry as a whole is losing $38 a pound, and of course, being miners, trying to make it up on volume. There is an established uranium industry in the United States, almost all of which is located either in South Texas or in Wyoming. And the United States is reasonably competitive in the uranium business on a global basis, not as competitive as an example as Canada, or certainly not as competitive as Kazakhstan. But the truth is that there are a couple companies in the United States that could generate decent cash at $40 a pound, but there's really nothing in the world, no company in the world that's viable on an ongoing basis at $22 a pound. Now, this sets up an interesting paradox because, as you pointed out in the question, nuclear energy generates 16 or 17% of total U.S. baseload generation. We're facing a situation where the industry that generates 16% of America's power is literally running out of money. The circumstance then is, if you believe 6 years from now or 7 years from now that when you come to your office in San Diego and flip the switch that the lights will come on, that means that you believe in higher uranium prices, because without higher uranium prices 5 or 6 years out, we will be missing 16% of U.S. baseload capacity.
So what would be the remedy to that?
Well, the cure for low prices is, of course, low prices.
Okay.
Eventually, what will happen is that the companies that are producing uranium for $50 a pound will either stop or go broke. There's 2 ways that you balance out a bear market. You either have a situation where the commodity price is so low that it adds utility for consumers. That's called demand creation. We aren't seeing that right now. The other way to balance supply and demand is through supply destruction. And when you destroy the ability to produce a commodity, the industry can't respond to later pricing cycles by increasing supply because it's a capital-intensive business. It's the same circumstance, Michelle. Supply destruction after a 20-year bear market in uranium that ended in 2002, that saw the price of uranium go from $8 a pound to $140 a pound in 4 short years. Clearly, an industry that makes the stuff for $60 and sells it for $22 is unsustainable. The price has to go up because the world, whether they like uranium or not, relies on it.
Now, I want to go back to one of your biggest winners from the turn of the century, Silver Standard. What was their game plan? And secondly, do you think that now is a good time to implement this strategy, given the valuations attached to the minerals today?
Great question. Silver Standard was certainly a spectacular success, and the credit, of course, is due to a business and geological genius named Robert Quartermain and the team that he assembled. The business strategy was that at the period in time when the strategy got implemented, the silver price was unconscionably low, below $5 an ounce. And as a consequence of that, nobody was exploring for silver and nobody was putting silver mines in production. And Quartermain and his group of investors, led by myself, believed that the silver price had to rise. The consequence of that was that we came to believe that mining silver during a period of low silver prices was stupid. You take a deposit, and because you think the price is going to go up, you produce all the silver. When the price goes up, you have a hole in the ground where your silver used to be. Really pretty stupid. So what we did, rather than exploring for silver or producing silver, is we raised money and we bought existing silver deposits from major mining companies that weren't economic at $5 an ounce, but would be economic at $12 or $14 an ounce. We were at the point in time that we were doing it in the early 1990s, buying projects that had $90 or $100 million spent on them, buying them for sort of 5 cents a pound in the ground. Mm-hmm. So we were buying the efforts that other people had spent $90 million on, and we were buying them for $1 or $2 million. Sure enough, mercifully, the silver price went up. When we started the exercise, if my memory serves me well, our first financing was at 72 cents with a full warrant at $1.25, and the stock reached a high of $45. I can't tell you how much fun it is to have a $1.25 warrant in a $45 market.
So timing is everything, huh?
Now, with regards to your question, is that type of hoarding strategy appropriate for today? The answer is absolutely yes. There are several different commodities on a global basis that are being produced for less than the cost of production. What that means is that if you run the economics on a deposit at what's called the incentive price, that is the price that the industry needs to maintain current supplies, you can often buy deposits for substantially less than that. As an example, in the copper business today, the incentive price is probably $3.50, but the market price is $2.40. If you buy projects that are out of the money at $2.40, but could be successful at $3.50, you may get some very good bargains. Certainly, the same opportunity is available and has been available in the uranium space, and certainly it's available today in the agricultural mineral space, the potash and phosphate space. I need to tell you that this strategy requires being well capitalized, patient, and tenacious. It can take 2, 3, 4, or 5 years to be right. And most retail resource investors, in fact, most institutional investors, would appear to have trauma holding stock over a long weekend. The consequence of that is that if you have the capital and the discipline to employ this strategy, it's a very certain way to make money. In fact, if you want an even more dramatic example than Silver Standard, one market entry with the same strategy, Lumina Copper, run by Ross Beatty, advanced in price from $2 a share to $160 a share. And the granddaddy of all of the hoarding strategies was Paladin Uranium, which went from 10 cents a share to $10 a share, a 1,000-fold increase in 6 short years.
Oh, my God.
Wonderful stories.
Yes.
Just don't ask about my losers, Michelle.
Exactly. Now, Rick, do you view the GDXJ rebalancing as a positive event for value-seeking investors?
I absolutely do. And an interesting illustrative story, too. The GDXJ, for your listeners' edification, the Van Eck Junior Gold Miners Index, is the first exchange-traded fund that I have ever seen that has become so big that it moved the sector rather than the sector moving it. The GDXJ added liquidity to a small subset of the sector and robbed liquidity from the rest of the sector. And probably of equal importance, as much as 50% of the net asset value of the GDXJ was contributed by feeder ETFs, the double and triple long nugget and dust ETFs. The consequence of that is that you had a 2,000 stock sector that was being driven by the 60 stocks that were components in the GDXJ. And the GDXJ raised so much money that it was impossible for them to allocate the money in the junior mining sector. They had to buy their own sister fund. And whereas when they started out, the average market cap in the fund was under $1 billion, as a consequence of the size of the fund and the amount of money that they had to spend, the median market cap of a GDXJ constituent now is $3.8 billion, hardly a junior. The consequence of the rebalancing was that the smaller companies in the GDXJ, often the ones that had better relationships between price to value, had to be sold off in the GDXJ because they didn't have sufficient liquidity to absorb the capital, while the larger, more liquid names, irrespective of the value, went up. The real opportunity, I think, is going forward. Everybody else that I know of is saying that the opportunity is over now that the rebalancing has taken place. But in truth, the real opportunity will play out over the next 18 to 24 months, because the GDXJ will still be an important distortion in the market, crowding the capital into 20 or 30 of the biggest names, raising their share prices and lowering their cost of capital at the same time that they starve other companies that aren't constituents of capital. The natural circumstance where a small number of players have a very low cost of capital, i.e. a high share price, and the rest of the industry has a high cost of capital, i.e. a low share price, will be over the next 18 to 24 months for the big names in the GDXJ to use their cheap currency, their high-priced stock, to acquire the smaller companies. The arbitrage will be to figure out which companies that are not GDXJ constituents are strategic fits, strategic takeover targets for the companies that are GDXJ constituencies. And this, I think, will be a spectacular opportunity for value-oriented rather than momentum-oriented investors.
Wow, so it's really in front of us.
It is. It's on us right now.
Now, during the 2009-2011 bull run, what was your biggest winner?
Probably Reservoir Minerals, which was really a discovery stock, in addition to the fact that, of course, there was a nice market. They made a very important copper-gold discovery. And if my memory serves me well, at the beginning of the exercise, it was a 40-cent stock, and the takeout was in the sort of $8.50 range. Quite pleasant.
Very nice.
The increase in share price was more due to their discovery than the recovering market, but it did take place in the time frame that you specified. That stock would have done well in any market circumstance as a consequence of the spectacular nature of the discovery they made.
Now, Rick, do you personally also own any dividend-paying companies with no relation or correlation to resources?
I do as a retail investor. I don't advise customers on buying them, but I am an occasional investor in general market securities, particularly general market securities in the financial services industry, which is a business as a consequence of being in that industry that I understand. So yes, I do own general market security stocks. I also have a small personal position in the Vanguard, S&P 500 index ETF, but just a passive position.
Now, here's a big question. How much luck is needed in order to succeed over the long term in mining?
Michelle, you make your luck. People need to understand that. You make your luck. Yes, fortune is required, but the truth is that there are some people, some teams who have been serially successful, serially lucky. What your listeners need to understand, what younger investors need to understand about the mining business is, at least in its early stages, in the exploration and development business, it's not an asset-intensive business, which is what people think it is. It's an intellectual property business. You are taking a piece of ground and you are applying intellectual capital to it. You are developing a thesis with regards to where the value is there, developing a means to test the thesis, testing the thesis itself, and adding value by applying intellectual capital. It's really similar to businesses like software or drug development. And what you learn is that the best scientists have the best luck, irrespective of the task in front of them. So you make your luck. The truth is that there are something like 2,000 public companies in mineral exploration in the world today. And you have many, many, many management teams that never experience any luck. That isn't to say their share prices don't go up. But then you have these serially successful people like Bob Quartermain, people like Ross Beatty, people like Robert Friedland, people who've been successful 5 times or 6 times. Buffett famously says there's a whole bunch of good basketball players in the world, but to win basketball games, you got to have a couple of 7-footers. That's how you get lucky. And when investors and speculators are looking for luck in the minerals business, the first thing that they need to do is look for management teams that have been serially lucky in the past.
You've mentioned that a couple times, the management team. So it's really all about the brain of the leader.
All about the brain of the leader. Many people make a mistake of thinking that this is about a property. Michelle, when I was in university, which was a long time ago, we were taught that about 1 in 3,000 mineralized anomalies becomes a mine. That's pretty horrible arithmetic. That, however, doesn't take into account the fact that there is a small group of men and women in the business that have performed so well that they add legitimacy and, in fact, even luster to the game. Success is disproportionately allocated to the best of the best in this business and other knowledge-intensive businesses.
Do you personally believe that the precious metals prices are being suppressed?
I do not. I believe that manipulation takes place in all financial markets, including interest rates and, as was proven in court, LIBOR. And the consequence of that is that trading desks will, of course, from time to time, manipulate precious metals prices, either up or down. I am not a believer in a long-term conspiracy to depress the price of gold and silver. I think that's been accomplished very handily by the strength of the U.S. dollar. I should note, however, that some people who do believe in those conspiracies make very credible cases. My own partner, Eric Sprott, disagrees with me profoundly. And your listeners should know I work at a place called Sprott. He doesn't work at a place called Rule. So there's certainly 2 schools of thought with regards to this.
Rick, this has been an amazing interview. How can listeners contact Sprott to get a free consultation or an introduction call?
Well, one of the things that we love to do is offer people who are interested in our services a no-obligation portfolio review. If those people will email me their natural resources portfolio, and by the way, I'm an old guy, Michelle, I'm not a millennial, so you gotta put it in the text, not as an attachment, with the name and the symbol of the stock, I will email back a ranking, a discussion of their portfolio. My personal email address is rrule, that's RRULE, at Sprott Global, SPROTTGLOBAL.com. The other alternative would be, if you're in the United States and Canada, call us toll free at 800-477-7853. That's 800-477-7853. And in parting, I would urge the younger part of your audience to visit our website, www.sprottglobal.com. We have about 200 hours of free educational material on the site, including a 50-hour course that I did for the Colorado School of Mines called the Mining Investment College. When that product was fresh in 1996, it cost $1,000 to take the course. Now it's posted on our website as freeware.
That's amazing. Rick, thank you so much.
A pleasure. I look forward to a rematch.
Mr. Rick Rule, founder and chairman of Sprott U.S. Holdings, Inc. For the CEO's Open Discussion Corner, I'm Michelle Holliday at PortfolioWealthGlobal.com. Mr. Rule is considered to be by many one of the top 5 analysts and investors in the natural resource sector for the past 4 decades. Starting with entry-level jobs, he worked his way up the ladder and is now a wealthy man. Not only is he financially rich, but he is also incredibly rich with wisdom. Today, our interview proved that there is certainly a method to accumulating riches in mining investments. Portfolio Wealth Global's founder, Tom Beck, greatly appreciates Mr. Rule's business sense. Rick discussed with me today the importance of finding those lucky mining entrepreneurs, which really aren't very lucky. They are make-their-own-luck type of people. Those are the legends of the business and the ones that advance properties into mines. Tom Beck deems Keith Neumeyer, founder of First Majestic Silver and First Mining Finance, as the best of the breed. As Rick told me today, the optionality strategy inside the gold sector is ripe with opportunity, and Keith took First Mining Finance public 2 years ago and grew it to be the premier mineral bank for gold in the Northern Hemisphere. Go to PortfolioWealthGlobal.com/gold2017 for a full write-up by Tom on this company. It recently graduated to the Toronto Exchange. Keith will be on our show himself to boil down the company's immediate catalyst later this week. Thanks for tuning in to join us today for this important interview. For the CEO's Discussions Corner, I'm Michelle Holliday at PortfolioWealthGlobal.com.